From the morning reading, Netflix, Harley-Davidson, United Healthcare, and others soar. Broad market jumps after earnings reactions. All 10 sectors moved higher on Tuesday. XLV, XLB, and XLU were the strongest sectors, while XLI was the weakest sector. Oil futures rose 55 cents to close at 50.62. Breadth strengthened compared to the prior session as advancers led 23.20 to 7.25 on the New York Stock Exchange and led 17.86 to 9.92 on the Nasdaq. On the S&P 500 snapshot, we have a Tuesday bounce. Today, with major equity indices around the globe bouncing back after Monday's weak start to the week, the Shanghai Composite surged 1.38%, the Euro Stoxx 50 closed with a 1.27% advance, and the benchmark S&P 500 jumped at the open, sold off to its 0.42% intraday low near the end of the first hour of trading, and rallied to its 0.84% midday high. It then traded sideways until the final hour when some of the selling trimmed the closing gain to 0.62%, a welcome advance but not as impressive as some of its key Asian and European index cousins. The yield on the 10-year note closed at 1.75%, down 2 basis points from the previous close. Treasury bond ETFs are trying to bounce off the 200-day average, so are rate-sensitive utilities and REITs. Consumer cyclicals trade sideways but underperform the S&P 500. United Healthcare keeps XLV above the 200-day line. The S&P 500 keeps bouncing off the September low as global stocks rebound. A pullback in treasury yields may be helping. Gold miners also find support at the 200-day line. In other news, speculative issues have reached a 16-year high. In the RightX family of mutual funds, traders have allocated more than $2 in assets betting on a market rally for every dollar invested in the money market or inverse funds. That's the widest ratio since 2000 and at a level that has been eclipsed only 3 distinct times since 1994, all of which led to struggling stock markets. At least options traders are hedging. In active ETFs like the SPDRs, Qs, and IWM, there are twice as many put options outstanding as call options. This has been much more of a smart money indicator over the past 5 years, with higher levels of hedging activity leading to poor stock returns and low levels leading to good returns. That makes the current 5-year high in the ratio a negative for stocks here. Stocks keep seeing intraday selling pressure. For the past 3 days, selling pressure has come into the market during the day, with the S&P 500 closing below its opening price. Despite that selling pressure, the index is still higher than it was on Thursday. That's commonly considered a negative setup for future returns, but historically has been the exact opposite in the short term. Ultimately, you have short-term indicators suggesting a bit more rally, likely toward overhead resistance at the all-time highs. It could conclude with the failure to break above the declining trend line that forms the top of the descending triangle, but with short-term indicators seem a bit more bullish than that. Intermediate indicators show downward pressure on price. This pressure will likely overcome a continuation of the short-term rally. Hello, this is Stephen Harris, a head trader from Falcon Global, where we model best practices for investors, traders, and day traders from entry to exit every trading day. In this daily video, I'll provide my opinion and insights of current market trends, market timing, volatility, and hedge risk levels for the upcoming day for the key U.S. financial markets. It is 6:49 a.m. Mountain Time, and I am recording this in preparation for the market day of October the 19th, 2016. Full disclaimers are at the end of the video, but be aware that this is for educational purposes only, and only you are responsible for the investing or trading decisions that you make. Okay, let's go ahead and dive into the morning report. And at the time of this cut, the 4 broad market U.S. indices were a bit mixed, but all around scratch, with the S&P, the Russell, and the Dow all just above scratch, and the Nasdaq just below scratch. Crude oil was up nicely at 1.52%. The euro was down just below scratch, as was the long bond. Gold is up about 0.75%. In overseas action, China just above scratch, Hong Kong below by about 0.33%, Japan just below scratch, Germany and United Kingdom just below scratch. I should have said Japan just above scratch. In terms of macroeconomic reports of note for today in the United States, we have building permits, crude oil inventories, and FOMC member Dudley speaking. Looking forward to tomorrow. Items of note: the weekly unemployment claims, existing home sales, nat gas storage report. That should wrap it up. In terms of current volatility conditions, we continue to be exceptionally low. Short-term VIX is a 12.45, skew benign below the 125 threshold. IV percentiles all still in the lower third of the annual range. S&P at a 29, Russell 29, the NASDAQ at a 24, and the Dow at a 30. We've now gone 5 sessions in a row with no standard deviation size moves on a close-to-close basis, including yesterday. In terms of the current charts, let's go ahead and bounce over there. In our current action in the S&P futures, we're still stuck in this kind of consolidation sideways range. The bulls have held the important support area. We had multiple trading sessions of indecision candles, but that has now moved slightly up. But we're still inside the overall trading range, still inside the cloud. Very, very neutral stance at this point. Though the very, very short-term action has been more positive. In the Dow, the exact same pattern, still in the cloud. A little bit of sideways consolidation and indecision, leading to a little bit of an up move here of late, but still in the cloud. NASDAQ has been, of course, the most bullish of the 4 indices, and right now seems to be setting up a little bit of a bullish flag, though doesn't seem to be going anywhere very quick. And indeed, that was the question I posed with yesterday. Yes, we had some bullish action with yesterday's action, but will we go anywhere? Will we actually achieve anything? And that has been the struggle of late as we've had so much of this sideways consolidation. Of course, the Russell had been more bullish than the S&P and the Dow. It has degraded down into the cloud and is really quite neutral at this point. Some weak, slightly bullish action of late, but hasn't actually achieved anything as of yet. Let's look at some of the other markets. Crude oil's up and near the 52-week high. It'll be interesting to see how the price action reacts when we get to that overhead resistance. Right now, that is something of a significant area of resistance with multiple touches in the area without having any kind of penetration even on an intraday basis. On gold has seemingly found something of a short-term bottom. We'll see where this goes. A lot of overhead resistance. We're below the cloud, and now all your moving average lines and so forth are stacked above you. So the question is does this just form a bear flag? And do we have a new intermediate term trend to the downside, or does this recover its former area of consolidation and then lead to new highs? This has been a very difficult pattern all year with many very technical consolidations before making new highs ultimately each time. And then let's take a look at long bonds. Long bonds don't seem to be doing much here in the last several days. Obviously, the intermediate term pattern now is for lower highs and lower lows. And as yields climb, the long bonds seem to be finally starting the great unwind. We'll continue to watch this and see how this develops. And then current volatility has been falling after a bit of a push up towards last week, but right now we're trading around a 15 handle, so relatively benign and not any signal there of anything other than slightly bullish activity being priced into the fear index, our VIX. Okay, that should be enough on that. Let's go ahead and go to the daily report. And still, market phase 5, the break of diagonal support. We have not yet broken horizontal support, and that would be of great significance because given where our current horizontal support is, if that breaks, we could set up for a fall of some 100 points in the S&P futures points. In terms of the three market timing signals, the first one from IBD, we definitely have an area of concern with uptrend under pressure. The second signal, GMI index, a poor 1 out of 6 with an outright sell signal in place since 10-12. And the third market timing signal coming to us from stock charts, decision point scoreboard, and you see the short to intermediate term on 3 of the 4 is decidedly neutral to bearish against a long-term mixed signal. So this is definitely continues to be quite weak. No change after yesterday's price action. There ultimately is, in the consensus of these 3 market timing signals, a slightly bearish, but you could probably call it neutral to bearish overall signal. That combined with some of the other signals, though, continues to give us cause for concern. We will say that position sizing opinion models are both coming in, one at 50% and one at 75%, the same as been in recent sessions. The intermediate term market posture with yesterday's action on the S&P turned into just about the weakest bull setting you can get. We've found that in recent price action, recent months, that these first day weak bull signals have been exceptionally poor and very, very short lasting signals. And indeed, liken this to the analogy of the football, and your team has the ball, but you're sitting there at about the 5-yard line with 95 yards to go for a score. So this is about as weak a bull signal as you can get. And you see the other 3 indices, the Russell severely strong bear now, NASDAQ weak bear, and Dow strong bear. So not a lot of reinforcement to this very weak bull signal for the S&P. In terms of the hedge warning status, we still continue to be hedge level 2, red light. So we definitely have a lot of areas of concern. If we get a break of that horizontal support, this could deteriorate quite quickly into something much more serious. In terms of the 3 strategy opinions, the option income strategies, VIX is inside the acceptable window. It's only a 15. However, overall conditions are borderline acceptable for novice traders to initiate new positions. More aggressive traders may find that the slightly higher premiums and the bit of price action that we have is setting up nicely for your option income strategies, but just be prepared for a potential breakdown. In terms of covered calls and put selling, our current opinion is conditions are not acceptable to initiate new positions for those that are novice traders. More aggressive traders should be very defensive in their stance. A 2-to-1 ratio of in the money and out of the money strikes. Aggressive traders also should consider a 2-to-1 ratio of low beta versus high beta positions. Consider legging in. Also, position size and the scale that you are willing to own, especially with respect to put spreads and selling of puts. Make sure you are willing to own those shares should that market breakdown occur. Now, in the individual warning areas, this is one of the more confusing parts of this. We're relatively light in the volatility area. Volatility is not pricing any kind of fear in, and you wouldn't believe that we're so close to such an important horizontal support area and looking at the various fear indicators. Current distribution day count on the NASDAQ's now dropped below 5, so no longer is in the warning area. The S&P just above that, now fallen to 6. And indeed, remember, we had only, you have to go back 6 trading sessions before you get the last standard deviation size move. In terms of trend base, you still have this market phase 5, though we did have improvement yesterday with the market posture for the SPX turning to that very, very weak bull. Nothing of note on the New York Stock Exchange new high to new low indicator, though our key intermarket risk aversion indicator still has 4 of these as risk off, and that is perhaps one of the more concerning areas. Sentiment, relatively benign. In fact, the fear and greed index Went up a little bit from a 36 on the previous session to a 41, still in the fear category, but certainly fairly close to an overall neutral stance. And if you look at yesterday's sector-specific breadth, it's about as green as it can get. Obviously, there was some companies that were down, but all these sectors very green, and breadth was very, very wide. So, nothing really to kind of outline there. Now, in the overall sector-specific market posture, we still have no green in the short or intermediate term, and really very little even in the long term. And these are pretty weak. If you saw these signals, you'd see that they're just barely above the lines to go to neutral in some cases. So things are a bit of a Tuesday turnaround bounce that often seems to happen on Tuesday. And yet on our 5-day, 1 month, 3 month performance, we haven't actually achieved anything as of yet. So we'll have to watch and see where this develops. Do the bulls come in and hold the line? Do they hold the support? Or does this just act as a short-term bounce and then set up into a bear flag and on down? So that's where we currently are. Let me go ahead and get this published. I had to download a new piece of software. I could not get yesterday's out with the audio had problems. So let's go ahead and get this one to publishing. In the meantime, always have the disclaimers. Hit the pause button if you need more time to review the disclaimers. Also note the hyperlink down here at the bottom for the full set of disclosures. Manage your risk, and if you do that, everything else should fall into place. And we'll see you back here for the next market preview session from Falcon Global for tomorrow. In the meantime, good trading.